Imagine this. You're sitting at your desk, working hard for every dollar you earn, and every payday, a big chunk of your income is swallowed up by taxes. Frustrating, right? What if I told you there's a way to keep more of your hard-earned money, build wealth, and secure your financial future, all by investing in real estate? We'll cover everything you need to know about depreciation, from the basics to advanced strategies, real-life examples, and expert tips. So make sure to watch till the end for all the valuable insights. Depreciation is a powerful tool in a real estate investor's toolkit. It's not just an accounting trick, it's a way to significantly reduce your taxable income. But what exactly does depreciation mean? Depreciation allows you to deduct the cost of a property over time. Essentially, it's a way to account for the wear and tear, deterioration, or obsolescence of the property. Let's break this down with an example. Suppose you purchase a residential rental property for $275,000. This amount includes the cost of the building and excludes the land value, which isn't depreciable. First, we determine the basis of the property, which is the purchase price of the building. In this case, it's $275,000. Next, we divide this amount by 27.5 years to find the annual depreciation deduction. So you can deduct $10,000 each year from your taxable income as a depreciation expense. Did you know you can accelerate depreciation on certain parts of your property? This strategy is known as cost segregation. Cost segregation allows you to break down your property into different components, each with its own depreciation schedule. For example, carpeting, appliances, and landscaping can be depreciated over 5, 7, or 15 years, instead of the standard 27.5 or 39 years. Let's say you purchase a commercial building for $1 million. A cost segregation study might reveal that $200,000 of that is for components that can be depreciated over 5 years. Instead of depreciating $1 million over 39 years, you now have $200,000 depreciated over 5 years and the remaining $800,000 over 39 years. This means you can deduct more in the earlier years, which significantly reduces your taxable income in those years. For instance, $200,000 divided by 5 years equals $40,000 per year. There are additional ways to accelerate depreciation, like bonus depreciation and Section 179 expensing. Bonus depreciation allows you to deduct a large percentage of the cost of certain properties up front. For example, if you buy a qualifying property for $500,000, you might be able to deduct 80% of it in the first year, thanks to bonus depreciation. Section 179 allows you to immediately expense certain types of property, like equipment or furnishings, up to a certain limit. If you spend $50,000 on new office equipment, you can deduct the entire amount in the year you purchase it. Let's look at some real-life examples of how investors have used depreciation to their advantage. Meet Jane, a software engineer who bought a rental property for $330,000. The basis for depreciation, excluding land, is $300,000. Jane can depreciate $300,000 over 27.5 years, which gives her an annual depreciation deduction of $10,909. Jane earns $8,000 annually from her property. With the $10,909 depreciation, she shows a loss on paper, reducing her taxable income. Now, let's look at Mark, who invested in a commercial property for $1,200,000. A cost segregation study revealed that $250,000 of the property could be depreciated over 5 years. Mark can depreciate $250,000 over 5 years, giving him $50,000 annually, and the remaining $950,000 over 39 years. With this accelerated depreciation, Mark's taxable income is significantly reduced in the initial years, providing substantial tax savings. Here are some expert tips to make the most of your depreciation benefits. Keep detailed records. Maintain accurate records of your property's purchase price, cost segregation studies, and annual depreciation deductions. Consult a tax professional. Work with a tax advisor who understands real estate investments to ensure you're maximizing your deductions and staying compliant with IRS rules. Plan for depreciation. Recapture. Be aware of depreciation. Recapture when you sell your property and plan accordingly to minimize its impact. It's important to note that when you sell the property, you may have to pay depreciation recapture tax on the amount you depreciated. This tax is generally at a rate of 25%. For example, If you depreciated a property by $100,000 over several years and then sell it, you'll owe taxes on that $100,000 at a 25% rate. To manage depreciation, recapture, and maximize long-term benefits, consider these strategies. 1031 exchanges. Defer capital gains and depreciation. Recapture taxes by reinvesting in a new property. Hold long-term. Keep properties for extended periods to spread out the impact of depreciation recapture. Strategic selling. Plan the sale of properties in years with lower income to offset the tax impact. Let's say you sell a depreciated property for $500,000 and use a 1031 exchange to buy a new property of equal or greater value. You defer the $25,000 recapture tax until you sell the new property. Depreciation is a game changer for real estate investors, providing significant tax savings and helping to boost your overall investment returns. By understanding and leveraging depreciation, you can reduce your taxable income, grow your wealth, and achieve greater financial freedom. Remember, always consult with a tax professional to ensure you're maximizing your benefits and complying with IRS rules. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more real estate investing tips and strategies. Have questions? Drop them in the comments below. Live as if every day is Friday.